My name is Lisa Watson. I'm Vice President of the NYU Alumni Club in Japan, and I'm currently in Tokyo. Before we start, please know that all of us at the NYU Alumni Club hope you and your family are safe and well in these unprecedented times. In light of the current global crisis, we have decided to move our events online for the time being and are glad that you have decided to join us today. For today's event, we have over 160 attendees from many different countries, including the US, UK, Singapore, and Monaco. Our event today is Real Estate Investment for Entrepreneurs. The speaker is Professor Harry G. Chernoff from the NYU Stern School of Business. Our moderator is Ren Ito, a 2004 graduate of the NYU School of Law and a senior fellow of the US Asia Law Institute at the school. If you have any questions during the session, you can enter them in the Q&A box on your Zoom screen, and we'll try to get to as many questions as we can at the end of the program. Please note that the viewing options and layout of your screen may differ according to your device and your version of Zoom. All attendees of this event are automatically muted. At the end of the webinar, once you close your window, you'll be taken to a questionnaire about alumni club events. So we would appreciate it if you could take a minute to respond. Now I'd like to start the event. Let's begin with Ren.
Thank you, Lisa. Hello, and a very warm welcome to today's NYU Japan Alumni Club webinar 2020 Real Estate Investment for Entrepreneurs. I'm Ren Ito, Senior Fellow at NYU School of Law and member of the Japan Alumni Club. With the help of my colleagues in the Alumni Club, I will be moderating today's event. This is actually, in effect, one of the inaugural sessions of Japan Alumni Club program after the COVID-19. And it's especially gratifying that we have such a large and truly global audience today. I like to think that with the size of today's event, we are testing Zoom to its very limits. We have people attending, just as Lisa said, from New York, Tokyo, and Monaco, some other countries in Asia and Europe as well. So such a really impressive range of countries and time zones. I'm just browsing through the participant list, and it's good to see so many familiar faces in the audience. Of course, as well as to be able to welcome, I hope, some more new friends. And the large part of the draw for this event, of course, is our esteemed guest, Professor Harry Chernoff. Harry is Professor of Real Estate and Operations Management at NYU Stern School of Business. Harry has a really rich business experience outside academia as well in the real estate and hospitality industries. Harry, you are an owner and developer of real estate projects in Manhattan, New York City area since 1980. You currently own and operate a number of properties in New York City, Las Vegas, Panama, including a hotel and a restaurant to which I have to be your guest for. He brings much of his real estate experience from industry into the classroom and today to our Zoom webinar. So Harry, well known to so many of you, I'm sure, is expertly placed to give insights into all aspects of real estate investment. Before we kickstart, I'd like to outline the order of the play today and some housekeeping rules. So this webinar will last for around an hour. And for the first 30 minutes or so, I'll be in conversation with Harry. And after which, we will open the virtual floor to questions. Where we can, we will group similar questions so that we can answer as many of your questions as possible. And it's always good to have questions in store, so please don't hold back. These sessions always work best if there is strong audience participation. Harry has very generously said that he's happy to answer any questions on absolutely anything. So audience, that the challenge is on. With that, Harry, thank you very much for your time today, and a big, very warm welcome to our webinar. I I know that many of our audience will be very, very interested to hear your views on how we can get started in real estate investment, locate good deals, finding money sources to finance the investment, and probably best way, under the current environment where we all miss the university's classroom setting, let me try to make this webinar as close as possible to what your actual classroom looks like by asking, what's the first thing, Harry, you tell your students in your real estate development class?
Okay, welcome. Thank you for having me here. Let me just I am screen sharing. Okay, I'm gonna put up some slides that we can use to follow along. First of all, I'm very happy to be here and speaking to everyone around the world. I am located here in New York, close to New York City, but I have been isolating out on the end of Long Island, away from the city itself, and trying to get ready for this fall when classes will start again. And we're not told yet whether we will be doing classes this way online with Zoom or back in the classroom. That decision will be made in July and August at some point. So we're having to prepare both. What I'd like to start with in response to your question, Ren, is the way in which I start off my real estate development and entrepreneurship class. The main objective in this class is to get people to start thinking like real estate developers. And we will talk about two different kind of directions in real estate. One of them being someone who is just purchasing a home or an apartment, co-op or condo to live in for their own family. And then the next step up, which is to make a real estate investment that will provide an income flow and profits for the future. So we'll kind of combine these two and talk about the differences. I normally start my class with this slide, which shows two real estate properties. The one on the left is a large apartment building in Detroit in the US. And the one on the right, a very small two-story building in New York City, in Manhattan, on the Lower East Side, a street called Ludlow Street. And the question, what do these two buildings have in common? Well, at first look, students will be perplexed because they don't look like there's anything in common. If I wait long enough and get responses from the class, people will say, well, it looks like we're in a city, an urban setting, not rural, which is true. And some of the construction materials may be similar, that there is stone and brick. It appears that both buildings have on the ground floor some commercial spaces, and above either office or it's hard to tell on the New York space what's in that second floor above, but it could be residential even. And then the answers sort of stop, and people don't have an idea of what I'm looking for in terms of what is common. The answer is usually very surprising. Both of these two buildings are for sale on the market for $12 million. How is that possible? Well, for the large apartment building, it seems reasonable. 925,000 square feet at $13 per square foot. The other one seems to be overpriced, but reading further into the setup for this property, we see that it comes with the potential to add on to the size of the building. It is already zoned and approved for 20,000 square feet of commercial and 11,000 square feet of residential BSF, buildable square feet. This is an extremely important aspect of real estate for real estate developers. It's very important to know what you can do with a building after you purchase it to achieve the value that you're looking for. When you're planning the development of the property, you want to make sure that you're not overpaying for it in the beginning. You're paying what it's worth, and to estimate how valuable your deal will be, you want to estimate the sale price in the future. Sometimes short term, 2-3 years, sometimes mid-range, and sometimes very long term. How do you estimate these prices, both now and in the future? This is a very difficult thing to do and extremely important. One of the basic structures that's used is to use comparables. These are other buildings that are similar to the one you're buying and selling at some point. And it's important to find comparables, and it's tricky. We see here 3 pictures of bedrooms from a co-op apartment in a relatively close neighborhood in New York City, in Manhattan. It's within a 15-block radius, which seems to be a comparable. Can we use it? Well, the answer here is that these are not good comparables, even though these bedrooms look similar. But when you see the price that these co-ops are selling for, they range from $4 million down to $630,000. Why so different? Even within a short block radius, there's a very, very big difference frequently in value and neighborhood and type of building. So it's important to understand that and pick comparables that are really something that you can compare and justify the numbers that you're paying and selling for. As a developer, you are combining art and science. There's some mathematics to do, which we'll talk about. And there's some intuition also, reading the crystal ball to end up with satisfactory real estate deals. The current real estate market, we can read about it in the newspapers. Right now, we're facing difficult times and a lot of risk because we don't know the long-term effect, and to some degree, even the short-term effect of the pandemic COVID virus. We study it on a day-to-day basis, but things continuously change. Real estate prices have been increasing over the last 10 years, and we have to keep in mind that they are cyclical, and at some point they start to fall off. We face something called cap rate compression. We'll talk a little bit more in a minute about cap rates, but it's sort of a return on our purchase. And a cap rate compression is kind of saying giving us an idea that we've maybe reached the top or the peak pricing, and prices have been going up even though the property is still making the same amount of money every year. We need to look at both macro and micro factors. The macro factors, obvious things like interest rates, they're very important, determining how much debt we can put on a building. The demographic trends, we want to pick areas where, well, if we're building residential or commercial, we want to know that people and businesses are happy with that area or are moving into that area. The political environment is very important. This is having a huge effect on real estate in New York City. You see some photos of our mayor at the top, Mayor de Blasio, the governor of New York State, the Governor Cuomo, and of course, President Trump on the bottom. And the type of decisions that these leaders make have a strong effect on real estate. Last macro factor that we talk about is not just what's going on in US and New York or for Tokyo and Japan, but what's going on around the world. Where is the demand coming from? And we want to keep that in mind when we look for investors from foreign countries. What have we talked about so far? Well, important valuation, when we buy and when we sell, and what affects the valuation. For an entrepreneur, someone who's looking at one purchase, at least to start off, I think the micro factors are more important than the macro factors. You need to know what that one particular home or building, what's going to happen to that in the future. And that can be more important than the general effect of what's going on in the whole city or the whole country. Two very simple basic metrics are used to calculate returns, and we need to estimate these. Something called a return on asset. This is the definition of a cap rate when we hear that term. We take the operating income, net operating income, NOI, which is determined by if you are collecting rent and you subtract operating expenses, you get your net operating income, and divide it by the value or cost of the deal. That's both the purchase price and any money that you need to invest into the deal to get it to have the value added that you want. That ratio calculates your return or cap rate. Another important return is your return on equity. How much return you're getting on the actual cash that you put into a deal. A quick example, if you were buying a property for $1 million, had a rent roll of $200,000 and operating expenses of $120,000, we would get a net operating income subtracting the two of $80,000. So our return would be $80,000 over $1 million, or an 8% return or cap rate. What was the return on your capital? Well, if you bought the property with all cash, it would be the same as the cap rate. $80,000 over $1 million of cash, still 8%. What's an alternative? Borrow some of the money or finance part of it. If you borrowed 70% or $700,000, now the cash in the deal is only $300,000. If you're borrowing at a market rate these days of approximately 4% interest, the debt service would be 28, and our cash flow for the year would be our 80,000 minus 28, or 52,000. What does that do to our return on equity? Well, now we're making 52,000 a year, but the denominator has been reduced to only 300,000, and our return is 17%. This is the effect called leverage, and it happens when you borrow part of the money that's needed for a deal rather than using your own cash for all of it. It's recommended even if you have the money you need for the purchase. Why are you interested in real estate? It's supposed to have big returns, throws off a yearly cash flow, and hopefully you get long-term appreciation. Everyone has their own reason for buying real estate. Some people need a place to live, a home. Others, it's an investment that they want to make that they think is relatively stable. And people want to diversification on their investments. Put money into gold, let's say. Traditionally, it's a low yield. Treasuries and bonds have a large amount of risk these days. The stock market, very volatile, and again, an amount of risk that we might not want to take. In real estate, however, it's less volatile. There's a potential to generate a good cash flow, and there's a lot of properties for sale. It's relatively easy to get involved if you can find the deals and you can find the money. This is one of the things that I try to emphasize in the course, how to shop for properties and how to shop for partners who have money that can go into business with you. Both of these are skills that you can develop and practice. And when I use the term shopping, it's similar to buying any goods that you're looking for. If you're trying to find the best price for a pair of shoes that you like, you would go to a number of stores and check out the prices before you purchase. This is something that's effective to do with real estate also. That's pretty much the general direction that I tried to get the students headed in or to start thinking about. Does that satisfy your question, Ren?
Yeah, I think this is a very, very excellent intro for anybody who's like me at the beginner of this industry. And if I may, I shouldn't be like saying that I understand everything, but if I gradually decide to set my foot outside a classroom and getting to the real street to think about my investment, I just wanted to understand how should I get started. And probably one of the questions I may have for you is, how did you get started? How did you get involved in the real estate development? And because that will be leading to question or answer about how a person like me or our audience, our friends in the audience, can get started.
Well, okay, I'll tell you an interesting story about my beginning. As a professor, I would like to tell you that I studied real estate hard and learned it all in school, but this is not the case. As with many things in life, something happened that was a surprise to me, and often these surprises start off as things that are negative, and you want to take advantage of opportunities. My background was in science and mathematics. I started undergraduate in engineering and switched to a business school. I transferred actually to NYU Business School after 1 year of undergraduate, graduating with a management degree from Stern, which wasn't called Stern back then, but same school. Went on for my master's, and while in my master's got an opportunity to teach a course and loved it and said, well, maybe I want to be a professor. It was advised that I join a PhD program, which I did. All of these schools and degrees are from NYU. So I am a true alum of our alma mater, NYU. About a year into teaching at a very low salary, I started doing some consulting work in operations management and started making some more money and decided maybe I will teach part-time and do the consulting, spend more time on that, bring in some more income. So I notified the school that I would teach part-time and found out that NYU was not going to be very helpful to me as I do this. I was living in faculty housing, and there was a rule that if I went to part-time, I had to leave my apartment in faculty housing. So basically, NYU helped me by evicting me from my faculty housing apartment. Yep, I was kicked out. I needed to find someplace else to live, and this created a problem because I had never looked for another apartment since I was a student. So I heard about these new concept of, this is approximately 1980, new concept of co-op apartments, and I decided to possibly buy an apartment. I looked in the newspaper. There are apartments and condos and co-ops listed in the newspaper. I used the New York Times, and one day on a Sunday, I was watching a football game. I'm glancing through the newspaper, and I see an apartment for sale in the neighborhood right near Washington Square. And at the halftime of the football game, I decide to run over and take a look at it. It's only 5 minutes away. So I run over, I look at it. It's great. It's a one-bedroom, 1980. It's selling for $65,000. I called the bank and found out I could borrow almost all of it, $45,000. If I could come up with $15,000, $20,000 of my own money. And I tell the owner, who was a young woman who was she was getting married. She had never sold anything either. And we shake hands and say, we have a deal. Got a lawyer, closed, got my loan. Problem is, I went over to the apartment after I owned it a few weeks later and started noticing a lot of things that I didn't like too much. It was smaller than I thought. It was dark. There was very little sunlight. I should have realized that. It was on the ground floor of a very tall building and faced a courtyard. And I realized after being in the apartment for about an hour that I didn't really love it that much. And I thought, wow, maybe I made a mistake. Maybe I can get out of it if I can sell it again. And I decided to put an ad in the paper the same way I had seen and see if I could get my money back, sell it for the same $65,000. I got an immediate call from a couple that lived in the building. They were having a baby and they wanted to get to a one bedroom. They were in a studio. I explained to them what I had done. And they made me an offer of $63,000. And I said, at 65, I can get all my money back. I hate to lose $2,000. Can you increase? No, that was the most they could offer. So I said, well, I planned an open house for that weekend. I'll have it, see if anyone will give me 65. If not, I'll make a deal with you for 63. And I have the open house. Another couple, a doctor who with his wife and has a son who's starting school at NYU, they liked it a lot. And I explained to them the whole situation, and they offered me 64,000. And I'm thinking, wow, I'm going to end up losing some money on this deal. No one will go higher. So I said, well, it's better than the other couple. And I called them back and said, I got a higher offer of 64. And they said, well, we'll increase it to 65. Ah, I like that. I won't lose any money. I call back the doctor. He tells me he'll increase his offer to 67. And you can see what started to happen. The younger couple went up to 70,000, and in one day, back and forth on the telephone, the apartment was bid up to $84,000. The doctor ended up being the highest bidder, and I was learning. I realized that the market for this apartment was much higher than I had thought. I had made a very good purchase at 65. The woman selling it had no idea what was going on any more than I did. And luckily, I ended up selling it for 84,000, made a $19,000 profit, and a major light bulb went on above my head. I realized that if I was buying a real estate property, even one apartment, was a tremendous opportunity to make money. In only 2 months, I had made 19,000, which is just slightly under my full-time salary as a professor at that time in 1980. So I decided to make some structure to the learning and to look at the mistakes I had made. When I started teaching my real estate course, I said I should identify these mistakes for people learning about this so they don't make the same mistakes. And I've labeled this the top 10 basic real estate mistakes that you don't want to make. And I did make them. First, you don't want to buy the first deal you see. You want to shop and look at it. I should have looked at 5 to 10 different apartments in different neighborhoods to get a feel for the market. I found out that there were 2 other similar apartments in the same building that were selling for 80, 81,000 in that range. And I didn't know that. Neither did the seller, the woman who lived there. So don't move too quickly on it. Don't be unprepared. I had no idea what I was looking for. It might be a studio, it might be a 1-bedroom. I didn't even know the neighborhood other than I kind of like to be close to NYU so I can walk to work. But I didn't have a good plan set up, or what we call now an investment thesis. I asked no one for help. I thought I could do this on my own. This was a mistake. You should definitely get someone more experienced. I call it now a mentor. It can be your professor. It can be a friend who does real estate, and you can have more than one, but you want to run these ideas by them. Don't make quick decisions. Think about it. I should have gone home after seeing it first and say, I'll get back to you tomorrow, in a few days, next week, and give it some time so that you can analyze what you're doing and try to make a good decision. And I took out a loan, which I had to personally guarantee. So even though I didn't come up with all the cash, had I been in a situation where the apartment was worth less than 65 or even less than 45,000, I would have had to come up with the money from other things I own, and I didn't have many of them then. I didn't realize the risk involved with signing personally. When you buy a home, you're almost always signing personally on the loan. When you start to sell, now probably everybody hearing my story knows what these mistakes were, but they weren't clear to me in the beginning. I asked exactly what I needed. I should have made it a little higher and expected a lower offer. I was very, very clear and honest to the prospective buyer. I explained my situation and that I decided to change my mind and sell the property right away, the apartment. Tell everyone the truth about your strategy. This is always a mistake. I'm not suggesting that you lie to people, but you can keep your strategy to yourself and make sure that you're going into a situation where you have a well planned out strategy for the way you're going to negotiate the price that you're selling for. Be in a rush. NYU was friendly with me, but I was under the gun. I was supposed to move out within a month or two, and I was already into it almost 2 months, and I hadn't moved yet. And last, create a situation where you have to get lucky to come out okay. In my first deal, it turned out I got lucky, but I don't want to go into real estate investment hoping that I'm lucky each time. With more analysis and taking more time, you can make good investments and not have to be lucky to turn out profitable. Hopefully these mistakes will not be repeated and you can buy someplace to live or a real estate deal and be successful in your early deals. Very important to be successful in your first deal and all of your early deals. Doing a deal in my early days without much money, I had to sell them relatively quickly to get enough money to buy the next deal. Sometimes this is a good idea. Sometimes it's better to hold on to the deal. Keep in mind, you figure out the total cost of your project, get a certain amount that you're going to borrow. How much? This depends on your lenders, how much they will lend you. And the rest has to be invested by owners, cash. If you don't have enough money, find some partners and bring them in as equity partners. Share the deal with them. Now, this isn't possible usually when you're buying a home, but on an investment deal, I love working with partners and I still do it to this day. That was my start.
Thank you, Harry. I think this is a brilliant story. We've been receiving a couple of questions. So I will be asking the first question on behalf of just myself, but I'll be keeping my question briefly and then trying to get as many chances as possible for the question from the floor to be answered by you. So probably my question is related to your first part of the presentation, especially about a macroeconomic picture. So given the COVID-19 situation, so my question is more about the choice of the asset class. You have a real estate, you have the equity, you have bonds market. There are tons of other investment opportunities. And among those investment opportunities, why real estate? Maybe this is the basic question, or even a theoretical question. Plus, given this COVID-19 situation, there have been discretionary, deflationary trends in the past decades. COVID-19 lockdowns seem like risk aversion in the private sector will be increasing permanently, leading to more precautionary saving by household, less investment by business, and this policy interest rates. Now the policy interest rates is in all the major economies are at or below the zero lower bound. How do we leverage this? And how do you see the asset class?
This is difficult. You ask a lot of questions there, Ren, that are very difficult to answer right now, but must be answered. You must take a shot. So making any investment, let's keep this clear, involves risk. My feeling is that buying real estate controls the risk more than a lot of other investments. As I mentioned earlier, if you are putting your money in the stock market, I have been watching that market over the last couple of months due to the economy and COVID in the United States. It has been extremely volatile. It dropped off a huge amount back in March and early April. Then it recovered. And just 2 days ago, the Dow was down 800 points again in one day. I hate that kind of risk. It happens quickly and you have no control over it. Now, real estate development involves risk also, but it gives you more of a chance to manage the risk. Things move more slowly. You never wake up on a Monday morning and your property is down 30%. This is extremely rare. Maybe it has happened on 2 or 3 days in the last 100 years. The crash happened quickly, but for the most part, you can see gradual changes. And that's what we're looking at now. The problem in today's market is that we don't know exactly the effect that the pandemic is going to have. My feeling, and this is my opinion, is that it will be very subject to where you're located. Not even which country, but where in the country. So if you are located in a city like Tokyo in Japan or New York City in the United States, these are areas that traditionally have large demand coming from within the country and foreign demand. I do not see a crash in residential prices in New York City, even after COVID. Can it slow down a little? Yes. Might there be some small decreases? But I doubt there will be a fire sale and all of a sudden things will be very cheap. On the commercial end, this is harder to determine. We have learned a lot. Businesses have learned a lot. We've learned during the 3-4 months of shutdown that you can operate online. Here we are doing it in an educational situation, but offices can have their people working online. They might not need great locations and expensive rents. You don't have to travel for in-person meetings. Online commerce was hurting brick and mortar real estate even before COVID. So in the short term, offices and store leases are going to be affected strongly. I think the recovery will come again relatively quickly. Another area is delivery. In the hospitality industry, service industry, there have been huge changes. Restaurants that never did a lot of delivery have been learning how to do that. They are buying real estate and renting real estate in industrial sites. We have something we're referring to now as ghost kitchens, where a restaurant is buying a cheap location and doing their cooking and delivering from that location, rather than using their primary top location, high rent. So those kind of things are going to have a strong effect, again, in the short run. Tokyo and New York City, I think, will recover quickly, and the prices will stay relatively high. In the more rural areas, I think the effect will stay along, will be there for a longer period of time. So you need to analyze that depending on where you're looking to make your investment.
Thank you, Harry. Since that's excellent, and I'm in risk. So let me turn to more of the questions I'm receiving from the audience. So the first half of the question is more is maybe doing a deeper dive into what you have just kindly shared with us, which is more deep dive question about the timing, the kind of the properties, and the location of the property. So maybe this is combined with the broader question of how the COVID-19 is affecting those decision-making process. But the first $1 million question to you is now the rightest timing of buying the property, or we should be waiting for X months, Y months? So the timing question is, many of the people are asking you the timing question. And
it's very important. It's an important issue for sure. But the main thing to keep in mind, because things move more slowly with real estate, you don't have to get the exact right timing. In other words, when you can do good real estate investing at a peak market or at a bottom market. There's just different things to look for. So, but do you have to hit the exact week when the market is at its lowest? No, that's not necessary. Maybe you will buy at a little bit higher price, but it's gradually going to go up, and it will affect maybe how much money is made overall. But as you watch and see what's happening, you gain more information and you can reduce your risk. And as I said again, the main thing is not to get a loss or to get killed in an investment, especially in the early stages. So I would say move a little slower, wait a little longer, and be a little bit more assured that the market is on the upswing or on the downswing. You want to be pretty sure of that before you jump in with your investment. It doesn't have to be perfectly timed. Keep in mind, we make most of our money on a good purchase and a good sale, but very important is the analysis of how much cash flow is made while we own a property, if it's an investment property. And from a home, keep in mind that even if the home is not appreciating in value, if you have a place you love and your family loves and you are happy there and can afford it, and it has the amenities that you like, where it's located, good schools, good parks near the water, whatever things are you're looking for, that is extremely important for living conditions. And if the appreciation is slower, that's okay, because those purchases are usually for a longer time period.
Right. Maybe like many of our audiences are inspired by your example of ghost kitchen, for example. So if I may connect this ghost kitchen example with the broader circumstance of the COVID-19, if I may take an extreme point of view, after the COVID-19, world is changing completely differently. So people are moving out of the city center, moving to the suburbs, moving to the beaches. And maybe New York City, Tokyo is no longer attractive investment, the target, but what about Midwest? What about the other off the beaten path? How do you answer those questions?
Well, I think that for the high demand areas, I mean, we hear now people are moving out of New York City. I have yet to see apartments for sale, a condo or co-op, at a big discount. It hasn't happened yet. There is some small changes, rents may be lower a bit, but I doubt strongly that everybody is moving out of New York City for the country. And New York is a good example where I'm located out on the end of Long Island is near the area called the Hamptons. The real estate out here has skyrocketed. It's way up in value. Things are much more expensive than they were before. So maybe it shifted a little, but I don't think that will continue. I think people will be back living in New York City, or as I said, Tokyo, because of what it has to offer. In more rural areas, the change is less now, and the effect long-term will be less. So the issue is, when you're thinking of buying something, what can you afford? If you can't afford an apartment building in a very affluent area of Tokyo, let's say, that is not an alternative for you. So you move out of the city and you get something that you can afford. The risk is greater in terms of the demand, but you can afford to do the investment. So you have to find that spot that fits the level of risk and the amount of money that's needed. Usually they'll correspond to each other. Higher the risk, higher the return that you should be getting. Minimize the risk, you might not make as much, and maybe that's okay to make a little bit less and take less risk, at least on your early decisions. Overall, for the long term, we try to do the same thing we do with financial investments, create a portfolio. So you may have one investment in a great location that's very expensive with lower risk of demand, and other investments that are outside the city in a rural area, so that when one is doing well and another is not doing so well, you can balance them through your portfolio.
Great. Underneath the time pressure, let me pick up a couple of more questions from the audience, especially the practical ones. So one of the audience is asking you that this is their first time deal. So if you're looking for your first deal, just like your apartment in New York, the first one. So how do you usually source that deals? What will be the right media to find those deals? Do you have to be familiar with the neighborhood? Do you have to live in that neighborhood so that you have the exact know-how, what the neighborhood is like? Or another question related to that is about a partner. You mentioned in some occasions you may want to have a partner to invest in that real estate together. So for the first-time buyer's perspective, what will be your advice in terms of sourcing this, how to source the deals, and how, if you may, find a partner?
It's very helpful to do deals in areas that you know well. For definitely, you know what's going on. You don't have to rely on other people to ask them, like a real estate broker or something like that, and trust them if you know what's happening. So I would say stay in the beginning in your first investments in areas that you know well. If you want to do an investment in an area that you don't know so well, then it requires more time. You have to learn it. I would say never do the investment somewhere where you have no idea of what's going on with it. You can't just rely on other people. So you shop it. You go there, you look at 10 different properties or homes, maybe even 20. How do you find them? Use the experts. Use a real estate broker. Have them take you to places. See a lot of them. Every time you go and see another property or apartment, you learn more. You find out what you like, what you don't like. Go to see things you're sure you don't want to live there, but you will learn more as you do it. And put in that time and gain that experience. And then when you come up with areas and properties that you like, then you start crunching your numbers, do your returns, and see, what's the total cost? How much can I borrow? How much cash do I need? And if you don't have that cash, then you need to start to look for partners to share the cash and to share the equity or ownership in the deal. It's like juggling balls. You are looking for property and looking for money at the same time. You can't only do one. When you find a good property, you want to be able to move on it. You need to have some money set up already, and vice versa. So you do both at the same time. You'd be surprised when you start talking about real estate deals to your friends and colleagues at work. People start to say, do you take in partners? Can I make an investment with you? Lots of people are interested in doing this. So I've never had trouble finding people with money to share the cash expense with you.
Maybe my last question, picking up from the audience, is about how you're going to be securing the money and its effect. I got a just very, very interesting question 5 minutes ago popping up in my Q&A window, which says, quote, in today's low interest rate environment, how does that affect your deal-making structure? Because low rates seem to be driving up price. Do you see anything stopping this trend? Or maybe in other words, the low interest rate environment, is this necessarily the right moment, indicating that this is the right moment to buy?
I would say a yes on that. I think it helps real estate a lot, the low interest rates. It allows, number one, we talked about leveraging the deal. In other words, even if you have enough cash to pay all cash, I do not recommend that. I think you want to, if you had 500,000 and you needed that much cash for a deal, I would say use 100,000, borrow the rest, and do 5 deals, putting up a smaller amount on each one. This leverage will increase your return on the deal. It makes sense to do it. When interest rates are low, it makes even more sense to do it. Do the math, the simple calculation, calculate your NOI, subtract the debt service. The smaller the debt service is, the more money it leaves on the bottom, which is in your numerator for your return on equity, and will make that return higher. So again, you can look for deals that have a very strong return. That's good for you, obviously, for profit. And secondly, it's good for you because it will make finding investor partners easier because you can promise a higher return on their investment. So buying at a time when interest rates are low, or if you already own, refinancing with the lower interest rates is an excellent opportunity.
Right. I know that we were pressed for this time, but let me pick up just one final question very briefly. What do you see as similarity or the difference between investing in the United States, North America, or the Asia or other regions?
I don't think we can compare them that way. I would say pick, just like within the United States, it's very different to invest in one city or another city, depending on if it's urban, if it's more of a rural area, middle America, or in California and New York. I would say the difference between investing in New York City and in Tokyo are very similar. Investing in Milwaukee, a smaller city in the United States, and a smaller city in Japan, maybe Osaka or Hiroshima or somewhere else, they are very similar. So I don't think the difference is so much United States and Japan, but the parts of those countries, that's what makes the difference.
Right. Thank you very much, Harry. An apology to all those people who, we had so many questions that I couldn't get to everybody, so big apologies. But with that, I think I'm going to close the session today. Absolutely sensational session. So a huge thank you, Harry, from all of us. And I'm sure the audience is giving you a virtual round of applause right across the globe.
Thank you
For your incredible tour of the world of real estate investment. So thank you so much, and back to you, Lisa.
Okay, thank you, Professor and Ren. And before we finish, I'd like to make a few announcements. This session will be available for viewing in a few days on the NYU website under the Past NYU Alumni Virtual Events page. And we invite everyone to stay connected with the NYU Alumni Club in Japan on our websites and social media platforms listed on this page. And we also invite you to consider making a gift to the NYU Emergency Relief Fund for students facing financial challenges during the COVID-19 crisis. You can do that on the NYU website at nyu.edu/giving. And the NYU Alumni Club in Japan is looking for new volunteers. So if you're interested, email us at alumni.japan@nyu.edu with your first and last name, graduating school and year, current position and employer, and a short message on how you would like to be engaged with the club. And as I mentioned earlier, we'd also like you to respond to a questionnaire for the Alumni Club. So once you close this window, you'll be taken to the questionnaire, and your feedback will help us plan events that will better serve you. So that will be all from me, and we hope you enjoyed the event. Thank you all again for joining us, and we hope to see you again soon. Okay, bye. See you again soon.
Yeah.